Welcome to the Fear and Greed Daily Interview. I'm Jennifer Duke. We talk so much about local equities on this podcast, so today I wanted to look to the US and see what's happening on Wall Street. Now, of course, this is general information only, and you should definitely seek professional advice before making any investment decisions. Now, Josh Gilbert is a market analyst at social investment network eToro and a regular guest on the podcast. Josh, welcome back to Fear and Greed.
Thanks for having me, Jen.
So, how much exactly does our market here in Australia follow Wall Street?
Yeah, fair bit. So depending on how the US markets get on overnight is usually a good guide of how we can expect the Australian market to sort of open the next day. It's usually a bit of an indicator of what to expect. It usually gives us a bit of an idea of what's going to happen on the Australian market, because the US markets are the biggest in the world and they drive pretty much everything. The US is the biggest economy in the world as well. So it is a big factor. Again, the Australian market will trade by itself. So the performance that we've seen from the Australian market and the US markets this year are pretty stark in difference. So it usually just acts as a bit of a guide on direction. It doesn't always mean that if US markets are down, Australian markets will trade down. But yeah, they are usually a bit of a guide.
And there have been quite a few big tech IPOs lately in the US. I think chip maker Arm Holdings is a really big one. What can you tell me about that?
Yeah, so IPOs are sort of catching the attention of investors again, with some big name listings coming back to the market. You mentioned Arm Holdings there, which was probably the biggest name of them all, particularly recently. We had a big IPO fever in 2021 when we saw a record number of IPOs. Then obviously in 2022, we had a really difficult year for markets and for corporate businesses. It wasn't the most perfect time to list publicly, with share markets being in a pretty deep bear market. This year, things have obviously picked up. We're obviously in a much better position in terms of how confident corporate businesses feel about listing their businesses publicly. And I think that comes down to investor appetite as well. We also had, you mentioned that we had Arm Holdings, but we've also had Instacart. We've also had a couple of other names in that time as well. And as I say, it's a sign that corporate sentiment is improving. And as I said, and that investors' appetite for buying is still healthy. And that's a good thing. It shows that although we do have interest rates at near record highs globally, investors are still investing capital into financial markets, and they have been well received by investors. IPOs have caught the eye of investors. Arm, as you mentioned there, shares were up 25% on its first day of trading. And it's also important to remember as well that the number of stocks listed in the US is something like 40% lower than what we had a few decades ago. So IPOs give investors new choices in markets, and that's brilliant, especially given that we are obviously far lower than what we've seen many, many years ago. And I think that this isn't going to be the end. I still think we've got plenty of IPOs to come. We've got the likes of Birkenstock, obviously a big name here that many will know here in Australia.
Yes. That's
set to make its debut soon over in Europe. So there are still plenty of big businesses and big corporates that are flirting with the idea of IPOs. And for those investors that like them, I think they should keep their eyes out, because there's going to be more coming across Europe and the US soon.
You mentioned the effect of the higher interest rates and the fact that confidence is still actually high among corporates and investors, sort of regardless. Why do you think that is? What's driving that confidence at the moment?
So I think that we've now got this view looking ahead to sort of the year ahead, particularly. So usually when we get to sort of this period of the year, Q4 seasonality is usually really good. Everyone starts to sort of look ahead to the year. They're probably more positive on what's ahead. We don't sort of see those risks that maybe can come at us in the short term. And I think particularly if we look to sort of 2024, I think there is lots of positivity ahead, and I think that view is built on we're seeing economies being more resilient than many expected. We're avoiding recessions. We've got inflation that's lowering, and we've got this expectation that rate cuts are going to come in 2024. For now, we're sort of still in this period of central banks saying that rates will stay higher for longer, which is why we've seen a little bit of weakness coming from markets over the last sort of couple of months. But particularly in the US, core inflation is moving in the right direction. We've got earnings that are recovering, and we're going to see double-digit earnings growth next year. So I think investors are looking ahead to what is going to happen. And I think the biggest risk that we see is actually being out of markets, not being in them. Because, some of those best days can come when being out of markets, and what we believe is going to be, a strong 2024. And there are always things to worry about in markets. And so if you worry about what's happening in markets, there's always a good excuse to not be invested. We've got, higher oil prices at the moment, higher bond yields. But, we think these self-correct, especially on the oil side. And, ultimately the view of, earnings recoveries at double-digit growth next year and lower inflation and rate cuts, we believe that's an environment that sets up a good year for markets.
And it's kind of interesting because a lot of those features are very much global ones. But in Australia, we haven't had very much IPO activity at all lately. So why do you think that's the case?
Yeah, no, it's a good question, and I think that comes down to a couple of reasons. Obviously, our equity market is a little bit smaller than the rest of the world. It has underperformed really against global markets for a number of years now. I think that we do obviously see those smaller listings, but we don't really see those bigger name listings, if you like. And I think that can come down to performance. We've obviously still got a Chinese economy that is pretty weak, and a lot of capital that is ultimately overseas at the moment as well. So I think if corporate businesses are looking where to sort of list publicly, the ASX may not always be the first place that they look to. I think that will change, though. I think, as I say, we're going to start seeing more IPOs over the next 12 to 18 months. So I do think we will see corporate businesses decide to sort of list publicly. It will be a better time for capital markets. We will see investors putting money back into financial markets, particularly when we see those rate cuts happening. That will leave investors with the freedom to add a little bit more risk, and I think that's when we will start to see more businesses sort of going public, and I think Australia will be part of that.
Stay with me, Josh. We'll be back in a minute. I'm speaking to Josh Gilbert from eToro. For a lot of the Aussie investors listening, some of their most popular US stocks are obviously Apple and Tesla. So I don't want to be basic, but I've got to ask you what's happening with those, and also with some of the other big gainers this year. So Meta and Nvidia, what's kind of going on in that space?
Yeah, well, I mentioned it a little bit earlier, but we have had a bit of a slowdown. So we sort of peaked with US markets in July, and then sort of since that time we've kind of had a bit of a pullback. There's been a number of reasons for that. We've sort of had this US credit rating downgrade. We had the US Treasury announcing $1 trillion debt issuance plans. We've got this sort of weak summer seasonality from obviously overseas. And I think we saw a little bit of profit taking after what was a huge start to the year. You had the NASDAQ 100 up more than 40%. You had the S&P 500 up more than sort of 15 to 16% as well. So I think it was a healthy breather with that as well. But within that, you've still got, Nvidia that's up more than sort of 200%, Tesla and Meta up more than 100%. Obviously, a big part of sort of why Nvidia has done so well is sort of come from that, AI boom. They've reaped the rewards of this sort of huge demand that we've seen from consumers and obviously businesses alike, and they're leading that sort of race, and they're ultimately delivering, and I think that's really the key point. Their Q2 earnings that sort of came out late in August, early in August, they promised a big quarter, and they absolutely delivered. Revenue climbed by more than 100% year over year, and earnings jumped by more than sort of 400% as well. So when you're delivering those sort of numbers, that's the reason why we're seeing shares up so significantly. Then you've got Meta. They're obviously probably on a slightly different period to what we had with Nvidia, but they've gone into sort of this year of efficiency. 2022 was when we started to see interest rates come up. Inflation was obviously starting to peak, and you had businesses hunkering down. You had consumers sort of hunkering down. And then this year they've gone into cost cutting mode. They've completely saved billions of dollars on expenses. They've got back to double digit revenue growth for the first time in 2 years. And the 3.8 billion users that it has is obviously a bit of a help as well. And that's been a draw card for advertisers. It's brought advertisers back. So, advertising revenue has, what we believe, bottomed. And we believe that, advertisers feel more confident to sort of spend now, especially with, as I said at the start, economies being more resilient than we first thought. At the start of this year, the big conversation was recession, recession, recession. And ultimately, it's not been that. The R word has been resilient. And that's exactly what we've seen. So there's businesses that have done well. There have been businesses that have maybe underperformed. We can look to, things like the material sector. Obviously, China hasn't been a big help to that. You can also look to sort of financials. Those sort of businesses have underperformed, but we still look to tech as, as that sort of safe haven, if you like, that has continued to perform for investors despite what has been a difficult couple of years.
And I'm curious as well, because crypto is something that we were hearing a lot about previously. Now everyone seems to be just talking about AI. But what is actually going on with crypto at the moment? Is it still as hype as it was before?
Yeah, and it's a great point you make when you sort of speak about AI there, because I think that this sort of AI hype has sucked some of the lifeblood away from sort of crypto. That sort of volatility and these big gains that we've seen from AI stocks and the hype around AI has sort of taken, some of that excitement away from crypto. But having said that, Bitcoin is still up more than 60% year to date and is still the best performing asset class in 2023, which is pretty surprising. And many people won't know that, because we are used to sort of this huge volatility and these, big gains and these big falls, but the volatility has kind of gone. We do still see, sell-offs, but I don't think it's anything more dramatic than what we've seen from stock markets and, and other asset classes. Oil, for example, in the last sort of couple of years, we are still significantly off those all-time highs, which is, pretty important to know. So the all-time high was around 69,000 back in 2021. That's US dollars, and we're still a fair distance from that. We had some weakness recently as well, coming off the back of SpaceX writing off the value of its Bitcoin. When you have a big name like Elon Musk making moves in the crypto space, it's always going to make a difference. But similar to what I mentioned earlier with US markets having a good year next year, we think the fundamentals for crypto and particularly Bitcoin are aligning. We think that it's setting up for a strong year next year. First of all, we can start with that macro improvement. We mentioned that earlier, lower inflation, interest rate cuts. That's, really important for risk assets. As I said, it allows investors to take on more risk, and crypto absolutely falls into that category. Then we can look at the approval of spot ETFs, whether that's Bitcoin or Ethereum. We've got improving regulatory clarity. And then in April next year, we've got the Bitcoin halving, and every Bitcoin halving in its history has sort of been followed by a bull market. So although history doesn't repeat itself, it certainly does rhyme. But I think the big point to all of that is a spot ETF, and it seems we are getting closer to that reality. We had the BlackRock application that went through a few months ago. They've got a pretty stellar record for having ETFs accepted. I think only one declined in their long history. And then we had Grayscale. They had a recent court win to convert their current trust into an ETF. And it's so important because this allows institutional investment into the space, which we so need into crypto. It paves the way for new capital. And, I think that's going to be really important. We've even got the conversation now of central banks, diversifying their FX reserves to include Bitcoin alongside gold. We are talking about some smaller sort of Central Asian countries there, but still it's a step in the right direction. And I think, all of those sort of factors coming together, improving macro, a spot ETF, the idea of, an improving regulatory environment and the Bitcoin halving, again, investors are forward looking. They're looking ahead to what will happen, and all of, those catalysts combined, I think set up for a great period for crypto after probably being in the cold for a period there, as you say, sort of a lot of people forgetting or moving away from crypto.
Sounds like we'll be talking about crypto a lot more for the months ahead. Look, Josh, thank you so much for talking to Fear and Greed.
Thanks for having me, Jennifer.
And that was Josh Gilbert, market analyst at social investment network eToro. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Jennifer Duke, economics correspondent at Capital Brief, and filling in for Sean Elmer. Have a great day.